Welcome to Stocks in Translation, our essential conversation cutting through the noisy numbers, market mayhem, and hyperbole to give you the information you need for your portfolio. I'm Jared Blikre, and today we have Joe Brusuelas. He is the RSM Chief Economist with us, and Sydnee Fried, as always, on loan from another department here. We keep you busy. On the docket today, our theme is the U.S.-China economic tightrope that we are walking, and that we're going to tackle that nascent trend of reglobalization and how the two economies are faring in this post-pandemic world. And our word of the day, deleveraging. Easy come, easy go. No one said how hard it's going to be. Commercial real estate, a prime example, we're going to discuss. And this episode is brought to you by the number 200 billion. At the Berkshire Hathaway annual shareholder meeting this weekend, Warren Buffett said that that is how much cash the conglomerate might end up sitting on this quarter. So what does that say about the M&A space? Joe, Sydnee, first story of the week. We are coming off a really interesting week in the markets. We had that big Fed meeting last week. Of course, standing pat, but now it looks like Powell just kind of keeping the hopes alive for another rate cut. And then we got a little bit of a soft reading in the labor market on Friday. What's your take of the current events here?
Well, I think that the Fed's clearly setting up to cut rates later in the year. So I think they're going to do 2 25 basis point rate cuts. Now, I wasn't part of the 7 rate cuts starting in June camp.
Yes.
We had 3 starting in June. We've curtailed that a bit. We think 2 starting in September. I've got 1 in September and 1 in December. Should we continue to see cooling in the economy, continue to see cooling in the labor market? And if the PCE, now that's the policy variable the Fed uses to determine
the inflation metric.
Right. Yeah, that's right. If that's anywhere, at 2.5% or below, I'm very comfortable cutting rates in July. So I think that's what you're seeing this morning is the market repricing a bit of risk. As a matter of fact, when I looked before I came over, market's now priced in 2 rate cuts, one starting this fall, one early winter.
Looking nice and prescient here. Let me ask you about this labor market weakness. Personally, I have been in the no landing camp since last December when Powell kind of pivoted, but I'm seeing more evidence that maybe there are some cracks in the labor market. Maybe that Fed policy with its long and variable lags, as they say, there's still more tightening to be felt in the economy. What do you think about the labor market?
Okay, well, a couple things. Well, I would agree with you that the long and variable lags due to that 2 years of tightening, definitely beginning to bite a little bit harder. You can see it in manufacturing and you can see it in the housing industry. It's exactly where you thought you'd see. But I would take question with your characterization of the labor market as weak. It's anything but weak. What we really want to see is the sustained pace of labor gains each month of around 150 to 200,000. That's really the sweet spot. We would need to drop much lower to even call anything weak, right? The unemployment rate went from, I think, 3.323 to 3.863. I mean, it didn't really move, but we allocated it up to 3.9. So, all right, the labor market remains remarkably resilient. The reason why you had 175 as opposed to the 240 is state government hiring slowed for at least the month, but we'll see that whether that was 1 month or just a deviation from the underlying trend. As a matter of fact, during the month of April, the diffusion index, the 1-month diffusion index, we saw a broader scope of hiring across the economy than we saw during the previous month when we had the 315,000 added. So I think the labor market is doing pretty good. Now, we've got broad demographic changes occurring deep into the economy.
Secular trend changes.
Yeah, I mean, people are retiring. We need to devote more labor to healthcare. And that's what you're seeing. There's a corner of the market that, well, let's just say it's moving on its own pattern for its own agenda that will characterize any gains in healthcare as weak. No, that's simply not the case. As a matter of fact, when you're in these transitions, we really rely on meds and eds to help us make those pivots, right? Those acyclical industries where you're going to continue to see hiring, whether the economy's growing at 4% or it's growing
to your point, this is a secular trend change that we're talking about with implications. I mean, we're kind of the way I see the U.S. healthcare industry, we're just emerging out of the dark ages, and it's all upside in terms of spending. Hopefully it's allocated properly, but I think we're in the early innings here still. I want to get to China because we are talking about the U.S. growth story versus China. No, we don't have to repeat for our audience that China has sputtered in the reopening here, but the details, maybe you could give us some of the details of what has been a source of their problems. And we're going to talk about deleveraging in a whole other segment, but just broad strokes here.
Basically, they've got a debt overhang because their growth model has come to an end. Allocating risk capital towards modernization of housing and commercial real estate has reached its logical conclusion. The Chinese economy is stuck because they're going to need to basically deleverage.
They built too much?
They built too much, and now it's time to begin to write that off the balance sheet, which means you're going to have problems in the household and you're going to have problems in banking. The household, because you're going to have higher unemployment, which is the problem they have, and banking, the problem which they're only slowly beginning to address. Now, for anybody tuning into this should sound familiar.
I've heard this story before, not only in the U.S., but elsewhere.
In Japan, that's right. Yeah, we went through this from 2007 to 2014. Japanese went through it for, unfortunately, a couple of decades. So the Chinese really are at a point where they need to make some big calls on what's our growth model? How are we going to allocate risk capital? Because unfortunately in China, risk capital is a centrally directed decision. Right now, risk capital is being allocated towards manufacturing. So we're having tension being built up in the international economic system between China and the rest. Essentially what China's trying to do is export its burden of adjustment to its trade partners because they're going to rely on excess production in order to keep unemployment down, or at least at a minimum, and create the transition or the bridge over the next number of years so that they can deleverage. Now, here's the thing. This is really, they're asking their trade partners to accept a smaller share of global manufacturing output and production, right?
In return for,
well, essentially, China. Well, there's really nothing in return. It's China.
Okay.
China's just.
It's such a bad.
We're not getting anything in return.
No. Here's the thing. Great powers do this, right? The point is, though, if this was 2004, we all would have absorbed China's excess production.
Well, willfully, it was a different story.
Now that's clearly not the case. And what we see is you don't see Chinese exports increasing into the EU or North America. What you see is them increasing into emerging markets. So we're going to have a very different global investment environment going forward as all of us deal with Chinese excess production. My sense is that this is going to spill over in the geopolitical. So tensions are going to get a little bit more intense here over the next couple years between Washington and Beijing and all of its major trading partners.
Joe, let me ask you something. I've heard the term thrown around for Chinese stimulus, social financing.
Yeah.
What does that mean? Why is it called that?
Well, it's a way of providing risk capital that's not government directed, right? Chinese households, because they don't have the social safety net that we do, they have a much higher rate of savings at a time when you're deleveraging, right? Especially in the financial and banking sectors, right? There's going to be a dearth of capital. Risk is not going to be allowed, so you can't really leverage up. So they're going to need Chinese households to begin making investments, right? So that's one of these new terms that's being thrown around, and we'll see what shape it takes and whether it's successful. My sense is that if China really wants to return to growth, anywhere north of 2%, they're going to have to increase household consumption. So that's why I'm a little bit skeptical when I hear, these terms being thrown around. Yeah.
Well, and to be fair too, the Chinese policymakers, they got their back up against the wall in different ways than the U.S. might. Their currency has been under pressure. They've been forced to defend it at various times. And when they increase their social financing or they increase their outlays, that only serves to weaken the currency a lot of times, and then they get capital outflows, one of their worst nightmares that they've battled. They don't want people taking their investments out of China, so it's kind of a cycle there. It's not a virtuous cycle, but what do you think about that?
You just did a good job of describing what a debt and deleveraging cycle looks like.
Good job, Jared.
Save this for the next one.
Yeah. Look, the problem is that they need to sell more goods abroad to make up for the growth gap at home. They just have not recovered from the shock of the end of the growth model, the start of the debt and deleveraging period, and then the pandemic. So it's natural that you would think a depreciation of the yuan is in the cards, and indeed, that's pretty much what's happening, right? The problem, again, is that they face a very different global economic environment where Europe and America, Japan and South Korea are all de-risking from Chinese exposure. And that's what makes it so difficult. So, when we think about this, right, assumptions that the Chinese economy is going to grow 10% a year, then that's over, right? They're going to be like everybody else.
10% was a long time ago, yes.
Massive.
No, but it went on for 2 decades, right? That, in a nutshell, is the Chinese miracle. But that's over now. They grow somewhere between 2% and 5%. That's probably a pretty good year. When I talk to scholars who really spend all of their time looking at China, they'll whisper very quietly, their housing bubble is not yet done bursting.
So Evergrande 2.0.
Yeah, that 5% decline in home prices is probably more like 70%, right? That they're not growing, that their economy is actually contracting, that the households have pulled back on spending because unemployment has just jumped. It's one of the reasons why the Chinese stopped sharing, aggregate macro statistics, right? You want to know what I look at now?
What's
I'm
that?
looking at traffic patterns in the major Chinese cities to get a sense, alternative data.
Yes.
Right? Electricity demand to figure out actually what's the true state of play and condition of the Chinese economy. They won't be able to hide that.
I want you to save that thought right there. For our viewers, we're going to be taking a little bit of a break here. So if you are with us on the show, if you're on a streaming platform, you're going to see a little bit of an advertisement here. For everybody else, we're going to keep going. All right. So, Joe, we're talking about deleveraging. And in fact, that is our word of the day. We're just talking about some of the measures that the Chinese government has used over the years to protect against it. But in order to, I guess, talk about deleveraging, maybe we should talk about leveraging first and what that actually means.
Okay.
I think a good example could be buying a house. So if I want a $200,000 house, I put up $50,000 of my own money in cash. I get a mortgage for the $150,000, and I buy this $200,000 house. And if it goes up to $250,000, and I'm able to sell it right away, now there's costs, there's commissions in there. Let's take that out. I have just made $50,000, which is 100% return on my principal. In a sense, I was using leverage to buy this house. Now, deleveraging is the opposite. When I have this asset and I got to get rid of it, but what happens in a deleveraging cycle is when you have to sell the property or whatever it is, you're selling with a lot of other people. That could be a fire sale condition, so you're just in a race to the bottom, selling it at lower and lower prices. Your thoughts? How am I doing here?
You're doing pretty good.
Okay.
In a Chinese state, it's state directed, right? So the banks are directed on what sort of risk management parameters to put forward that governs lending for homes, more aggressive lending to engage in commercial real estate. Essentially, they've got too much infrastructure now, too many apartment buildings, too many single-family residences, and too many commercial real estate enterprises. A good way to think about this is, for the first time since they started publishing the statistics in 1990, there were more homes on the market available than apartments. That tells you that over the last couple of years, they've pulled back significantly on that sort of risk-taking. When you've got more than 1 billion people in your population, you have to house them, right? And I think it's fair to call what the Chinese have engaged in is modernization. They've modernized their economy. Mm-hmm. That modernization seems to have reached an endpoint for now, right? So that the banks themselves are not going to, their risk appetite has been diminished significantly by the quantity of capital available for that and the interest rate that they've been told to set. Then there's all sorts of other rules. You can't own more than one house, right?
Well,
There's
I mean, they used to
cap
have rules
speculation.
about that for families too.
Yeah.
They've been very heavy-handed over the years, to be sure. Sid,
Yeah. So what's the effect then for anybody as an investor?
sure. Sitting here as a U.S. investor, how does it affect us?
Okay, so over the past 30 years, it's been a one-way play, right? You could take capital and you could invest it in the domestic Chinese stock markets to buy an array of products that were aligned with the modernization project, right? Housing, commercial real estate, manufacturing. Think of those as the three legs of the Chinese economic stool. Well, two of the legs have been kicked out. And the other leg is now subject to significant international tension over just how much are we going to accept in terms of Chinese excess production, whether it be electric vehicles or even the cheap goods that the folks buy at Target and Walmart. Essentially, all of the assumptions that we've operated on for the last 30 years with respect to the Chinese economy had just been turned upside down. It really is a new world, and we're going to have to reframe how we understand how the Chinese economy operates and just what the risk is we're taking by investing in China.
Let's take electric vehicles. I think that's a prime example. I was just doing some research on the number of EVs produced in China.
Yeah.
Something like it was 8 million.
Yeah.
All right. In the US, it was 1.6 million. That's a huge disparity. And a lot of those are being made by a company called BYD.
Mm-hmm.
If you're a Warren Buffett fan, you probably know about them because Charlie Munger used to talk about it. But this is a company that is massively outproducing Tesla.
Yeah.
It's just kind of a sleeper story. So how does this play out in the EV world?
All right, so because I knew it was coming on the show, I was
Yes.
in Los Angeles last week on business, and I went over to the mall because that's where the Tesla showcases are, and I looked at the price of a Tesla, and I thought, this is nice. I've got a plug in my garage that this would work with. It was about a $125,000 car, how I would want that, right? Okay, and I thought, BYD, depending on what country you're in, that price ranges from about $16,000 to around $26,000.
And they have 30 models, something like that.
Yeah. So, you think if those automobiles were allowed into the United States, either directly from China or through a third party like the factory that BYD has in Mexico, right? Tesla is going to face fairly significant competition that looks a lot like what Ford and GM and Chrysler went through in the 60s and the 70s when my mom and dad could have bought that old gas guzzler but went over to Volkswagen and, well, they got that VW.
What's it going to take though? I know what BYD is now because we talk about it all the time on the show. If you ask any of my friends, no way. What's it going to take for BYD to be a household name, or is it just that they have to be allowed into the country?
They're not going to be.
Yeah, they're not going to be.
Yeah, the de-risking from
Yeah.
China in North America and amongst the G7 is such that my sense is that we're just not going to see them. There's not going to be a repeat of the deindustrialization that went on, in the upper Midwest, primarily caused by German and Japanese competition. Now, I'm a free trader. My sense is that was good. It got the attention because, GM and Ford and Chrysler had gotten complacent, right? They're the ones who
I remember
really
Lee
caused the
Iacocca
problem.
coming in the early 80s and turning things around. That was a huge story at the time.
But do you remember why it was turned around, though?
Because it was failing? I mean, I
No,
don't.
because the government bought cars.
Ah.
We used to call K cars. Yeah, the
K
government.
cars?
Yeah, you used to see government.
I remember
G-men-
K
G-men
cars.
driving around four-door pieces of insert your own expletive here. Yeah,
Every 70s show had a plethora of K
that's
cars
right.
in it.
And that basically saved Chrysler, right? But the quality just was never there, and Chrysler is no more. We call it by a different name. Right?
Yes, Stellantis,
It's for Stellantis. That's right.
whose trading symbol is eerily reminiscent of another.
Yeah.
We've accidentally stumbled onto something here. We have a segment at the end of the show called Who Wore It Better? And it's a metaphor, but we've actually been talking about it. So here it is. We were talking about the head-to-head competition that's been capturing the hearts and minds of economists and also investors here. And this is respect to EV production. So we have China, which has produced 8.5 million vehicles, EV vehicles last year, versus the US, 1.6 million. But those are the gross numbers only. Just thinking about the long ramp here, the secular story, who do you think is wearing the EV revolution better in terms of production? Is it China or the US?
Neither. It's BMW.
Excellent.
Ooh.
I like a sleeper answer.
Yeah, BMW's got the best right now. I know GM's got a EV Cadillac version. I've gotten to see the early look at it. I really like it, but we have to see what happens when they put it on the street.
Well, and how much they charge for heated seats, because that just didn't go over well.
Yeah, well, where we spend a lot of our time in Texas, I wouldn't be paying for that upgrade. But back in the day when I had my place with my big St. Bernard Jake out in Connecticut, I would have been definitely paying for the heated seat and that heated steering wheel, for sure.
Joe, I want to do something a little bit different. You've been around the street for a while. I want you to go back in your career. It could be early, maybe even stretching back to your school, but just give us a little insight into what captured you and made you want to become an economist.
Well, I got a job out of school at an investment bank. It was Great Western Investment Management in Los Angeles. They literally used to have investment banks in Los Angeles, believe it or not, which is now part of Wells Fargo. And I did the fixed income currencies, commodity, and research. I was one of the fortunate people to get to do the sort of all around the company. And I was a natural at it. And because I had studied politics and economics, and I was always very good quantitatively, and I was really interested in financial markets. It just made me want to do this. And then, the big thing was I graduated into the fall of the Berlin Wall, the opening up of the global economy and what we call globalization.
And so that was a huge watershed moment. Short term, did that cause some problems for the financial industry, or was it just full speed ahead? We're looking at 5-10 years in the future.
So nationally, it was full speed ahead. Where I was at in Southern California, we were dealing with the end of the Cold War, which was a drag on the local economy, and then the problems associated with the savings and loan crisis. So that all came to an end, and I went back to graduate school, which was the best thing. And from there, my career took off.
And you did have a job, at least on a short-term basis, I believe, before you entered grad school as a truck driver?
That's right. When we got laid off at the bank, because, last in, first out as it was back then, I don't know that it's like that now, right?
A little bit fair.
I think
Yeah.
you tend to keep people with the newer skill sets. Back then, they hired you and told you when the business cycle ends, you are going to be let go. But I did what they told me to do. Is I went back to school. I did my doctoral work at the University of Southern California. It was the best decision I ever made. And then, we fast forward and I'm here.
Hey.
Do you remember your first ever job?
I delivered pizzas.
I would have enjoyed
California. That was fun. I learned a lot about logistics.
Yeah.
And I learned a lot about people. And moreover, I learned a lot about how people value money.
Could you give an example?
Yeah, sure. You deliver a medium pizza with sausage and pepperoni. It's, $8.79. Okay, do they give you the extra 21 cents, or do you get the $1.21?
Very good.
You get a little bit of an idea about how people value money.
And also how to size people up, I would think.
Well, that too, right? And it's fun, it's a good thing to do when you need a little extra money. You're a young person, you're in high school or you're in college. And it really did help me understand, how foreign exchange, how dollars work, how currencies work. And then foreign exchange is a little bit of a different thing. And boy, over the last number of days, we can talk lots about foreign exchange, what's going on in the global currency markets due to the Chinese, due to the Japanese especially.
Yes. And Joe, we're going to have you back for that. Believe it or not, it has been 24 minutes. We are done here, at least temporarily, at Stocks in Translation, but keep your dial tuned to Yahoo Finance.